This week is exciting. Global markets are buzzing with optimism on potential rate cuts. India is seeing a sentiment boost from sweeping GST reductions, and IT stocks are back in focus, with Infosys grabbing the spotlight by announcing a massive 18,000 crore buyback at 19% premium. The move lifted sentiment across the entire IT pack, signaling management's confidence and a likely boost to long-term earnings. So let's break it all down. The markets, the drivers, the sectors, and most importantly, how to make smarter money moves this week. Welcome back to Signal, where noisy markets meet simple, sharp, and sound insights for long-term investors. Sensex closed at about 81,905 points, up by around 1,195 points from last week's close. Nifty ended just about 25,100 points, rising nearly 380 points from last week's close. As stated earlier, IT led the gains this week, with sentiment staying bullish across the pack. Small and mid caps also posted modest gains, and FMCG and consumption saw some profit taking towards the end of the week. Foreign institutional investors were strong buyers this week, pumping in 5,500 crore into equities on hopes of better global liquidity and supportive Fed stance. Domestic institutional investors like mutual funds and insurance companies booked some profit but remained net positive, helping the market's momentum. The rupee ended near 88.28 per US dollar, slightly appreciating as US inflation data kept Fed rate cut hopes alive. Overall, a week that started cautiously but ended with renewed hopes, supported by strong foreign inflows, global cues, and robust domestic consumption. AMFI's August 2025 data shows equity inflows of 33,430 crore, marking 54th straight month of positive flows. And the highlights were mid-cap funds led the way, SIPs stayed steady near 28,000 crore, and fund managers cut cash levels below 5%, putting more money to work. We'll uncover the full report in next week's episode. But for now, the big picture is that retail investors continue to stay disciplined and fund managers are confident to stay largely invested. Saving money isn't just about skipping coffees or cutting everyday joy or desperately waiting for that year-end bonus. It's about finding the right equilibrium between freedom and peace of mind, and celebrating little milestones along the way so that saving becomes a gratifying journey. Ramit Sethi puts this beautifully. Spend extravagantly on the things you love and cut costs mercilessly on the things you don't. And that's exactly what these 5 smart saving strategies are designed to do. Help you spend and save with intention, not guilt. And you may or may not have heard of them before, but the idea is to bring them back to the surface to either help you realign, re-strategize, and refocus if your spending has gone off track, or to offer a little breathing space if your saving habits have started to feel too restrictive. And guess what? To help you kickstart your saving goals, you can take advantage of the recent GST surprise that government handed in. Why not turn that tax cut into a fresh savings goal, your very own GST Gift challenge, and see how much wealth can be created from the money that you neither expected nor planned for. Saving strategy 1. Pay yourself first. Saving should feel effortless, not a burden. And in order to achieve that, set up your SIP or recurring deposit on your payday or salary day so that you save first and spend later. Saving strategy 2, the 2-bucket rule. Think of your savings in 2 buckets. Bucket 1, safety bucket for 3 to 6 months of expenses, about 3 to 5 lakh for most families, parked in a high interest savings account or short-term deposits or liquid funds. Bucket 2, growth bucket. This is your long-term wealth engine parked in equity funds, hybrids, index funds, properties, shares, and growth assets. One bucket protects you and the other grows you, And this balance provides you confidence, peace of mind, and future readiness. Saving strategy 3. Step up your savings. Each time you have a pay rise, let your savings rise too. Whether you choose to increase your SIPs by a certain percentage each year, or add ad hoc lump sums, or top up your deposits, small, consistent step-ups can increase your wealth by 40 or 50% more over long run than keeping your savings flat. It's a gentle way to reward your future each time your present gets an upgrade. Saving strategy 4. The 100 minus age rule. Finding the right mix of risk and safety doesn't have to be complicated. Use this simple thumb rule. 100 minus your age equals to percentage of your equity exposure. At 30, you invest 70% in equity and 30% in debt. At 50, it's 50-50. This simple generic thumb rule keeps your portfolio in sync with your life stage. But if you're truly serious about your long-term wealth creation, then you may want to consider getting a personalized risk profile by a SEBI registered investment advisor, because the right mix for your goals might be different to the generic thumb rule. Saving strategy 5. GST Gift challenge. This is practically a gift from the government. GST rates dropping on daily goods, cars, healthcare. Families are expected to save between 500 to 1000 rupees each month. Why not turn this stimulus into your very own savings plan and start building wealth today? And if you don't know how and where to start, then a good starting point would be to start calculating how much your family would save because of GST cuts. Set aside that amount, start an SIP or digital gold plan or a recurring deposit, and watch it grow. And if you wanted to understand how GST changes will affect your Ghar and Grahasti, do check out our video GST, Ghar or Grahasti on YouTube HP Wealth Insights. These 5 saving strategies don't ask you to give up joy. They help you build joy for the future. Pick anyone to start this week, even if it's GST Gift challenge, and let discipline do the compounding for you. For Story of the Week, please allow me to introduce Shalini, a brilliant medical practitioner, and Rohan, her husband, also a doctor. On outside, everything looks perfect. 2 beautiful children, Soumya and Ritika, thriving medical practices, and awesome lifestyle. But there was one problem they never talked about. Saving. Money always came, but just left as quickly. In our initial appointment back in 2022, Shalini looked at me and told me, Komal, we have earned more than 5 lakh rupees last month, but we have no idea where all has gone. Can you please help us? And how did we help? We started with cash flow analysis and discovered that there were multiple unused subscriptions worth 8,000 rupees each month. There were impulsive spends which neither of them remembered, and absence of any saving strategies. At first, they were uncomfortable, even a bit embarrassed. But we turned those discomfort into actions. Step 1 was to cancel all unused subscriptions and redirect 8,000 every month into their very first SIP. Today, when they see building, accumulating and growing SIP portfolio, they display a sense of pride of taking control at the right time. This is indeed their first win, but not the only one. Their second win takes us back to 2022 when they established education plan for Soumya and Ritika. Having a goal-based plan provides them clarity, confidence and peace of mind. Being high-income earners, Shalini and Rohan always believed that they'd be able to fund future needs of Soumya and Ritika. But having a structured plan adds to that confidence. Their third win was earmarking an emergency fund. Today, they have an emergency fund of 12 lakh rupees, providing them control over their finances and a confidence that no medical emergency or practice slowdown can throw them off track. Their their fourth win was to design a step-up savings plan so that every increase in their practice income was reflective of their wealth accumulation. And they have chosen to review this with us on an annual basis so that their income rise reflects their saving rise too. Today, 3 years later, Shalini and Rohan say that they finally feel that they are in control and they have sizable savings to demonstrate that. They do enjoy family trips and dinners, but every rupee has its own purpose. Saving no longer feels like a compromise. It feels like confidence, and that's the balance we all should be aiming for. What a transformative journey it has been for them, and we are so proud to have supported them through this change. Remember Ramit Sethi's quote from earlier? Spend extravagantly on the things you love and cut costs mercilessly on the things you don't. What he means is very simple. Things that truly matter to you, books, travel, experiences. Spend freely on it without any guilt, but ruthlessly cut back on things that you don't enjoy. Cancel unused subscriptions. Skip impulsive buys. Stop paying for things you don't enjoy. This way, every rupee has a purpose, either to make you happy today or to build your future tomorrow. We are building a strong community of savvy, steady and sophisticated long-term investors. If you're one of them, why not like and subscribe us and tell us in comments which saving strategy will you try first. We